Hi there, this is Aubrey Chauke. I'm a tutor for accounting, business studies, CMS, as well as research. If you're watching this lesson, you are definitely at the right place. Please don't forget to subscribe to our YouTube channel by hitting that subscribe button on your bottom right. And you can also like this video and leave your comments so that we can know the kind of videos that you prefer, and so that we can also be able to make more of such videos. With that being said, welcome to Online Lessons with Aubrey Chauke. Let's get into the lesson of the day. Tonight in our lesson, we're going to be talking about asset disposal. This topic is very important, especially if you are in grade level. You are almost affected by transactions that have something to do with asset disposal when you deal with your cash flow statement, when you deal with your income statement, and sometimes even the balance sheet. So we might as well make sure that we familiarize ourselves with this topic. With that being said, let's get into the activity and just understand what we are required to do. We are told to prepare the following accounts in the general ledger. The first account that we must prepare is the vehicles account. Second account, accumulated depreciation on vehicles, and the last account is the asset disposal account. And then they're saying that we should also balance or close off the accounts on the June, which is at the end of the year. And then we are given some information that we need to take into consideration when we deal with this account. We are given the opening balances for accumulated depreciation as well as the vehicles. Why am I saying that these are the opening balances? It is because that they are saying that on this date gives me the idea here on 1 July 2001. It gives me an idea that this is at the beginning of the year. So you must also be able to establish your financial period, be able to know when does the financial period of that particular company start. Okay, now what we need to do is that we need to be able to figure out the beginning of the financial year. Now what I've done is that because I have shortage of space, I think I'll try to work out the calculations of these transactions on a separate page, but you will still be able to see it on the screen, so that's nothing to be concerned about. So this is where we'll be doing our workings for that particular question. Now the first thing that I want us to take down is, when does the financial period start? Here we are told that the financial period starts on 1 July 2001. So this is the first thing that we need to be able to establish before we do anything, just so that we don't get confused with the question. So the year starts on 1 July 2000 to 30 June 2001. So we have already established our financial period. We know when does the year start and when does the year end. So we're going to use this information as we continue with our calculations. Now we are asked to open the vehicles account, which is this one, and then it is gonna cost us 7 marks. So you need to be able to identify what type of account is a vehicle. Is it an asset? Is it a liability? Is it an income or an expense? Before you open that account, you need to classify it first, and that will make things easy for you. And the second account that we have to create is the accumulated depreciation account. And this account is very important because if you check, most of the marks are focused here. The accumulated depreciation account costs about 22 marks, which is a lot. So it means we must be able to master our depreciation calculations. And then the last account that we have to prepare is the asset disposal account. This one is only 5 marks. It's not that hectic as long as you understand the theory. And one thing that I would also like to caution you on is the time. We are required to do this in 15 minutes. So you need to be able to do these calculations and everything in 15 minutes. This means you have to really practice. You need to put so much practice in this type of question so that you can be able to master the speed. Okay, now we are told that on 1 July 2001 The first thing that you should do is to always transfer the opening balances before you do anything. So we are told that on 1 July 2001, the balance brought down for vehicles. On 1 July 2000, the balance brought down for vehicles was 168,000. Okay, so you're gonna go to that vehicles account, then enter that information. It is this one. We know that vehicles, it is an asset, so it means that vehicles will have the opening balance on the debit side. So we're going to have 1 July 2000, and then we'd have balance brought down, which is 168,000. Just for this, for putting this information like this, you already have a mark. And we're also gonna come here. We know that it's supposed to be 1 July 2000. We must remember that accumulated depreciation has a credit balance, so it will be on the credit side. So here we're going to have balance brought down. This can also be called brought forward. Okay, so and then the balance brought down on that accumulated depreciation on vehicles, it's 56,000. You must understand what are we talking about when we talk about accumulated depreciation on vehicles. Accumulated depreciation, it's a collection of depreciations that have been calculated over the past years until recently. It means that if maybe, let's say for example, we've had this particular vehicle for 3 years, accumulated depreciation will include depreciations from all those 3 years until recently. So we've already opened the account as we are expected to do. In terms of the asset disposal account, it doesn't really have that particular account. And then here they gave you just some smaller space in Yana for calculations, but then personally I feel this space is not enough, which is why I'm going to work on the other side so that you can understand. But then if it's given to you in class, you can divide this into blocks using your ruler so that you can show that you are calculating different things and then get your totals. But then personally I feel this space is very small, so I'm just going to go to that page where I said we would do calculations. Okay, now they have also told us that we should close off their accounts, meaning that at the end of the year we should have the closing balance carried down, and then it should be transferred to the next financial period, which means we must know the closing balances for 1 July 2001. Okay, we should have the new balances. So we have already taken this into account. We have transferred our balances that were given to us. Now here they are telling us that we have sold one of the vehicles, which originally cost 42,000. Okay, so we've already sold a vehicle that was costing us 42,000, and then they're saying we only sold it for 18,000 on cash on 31 December 2000. Okay, and then they're saying that the accumulated depreciation on this vehicle on 1 July was 14,000. Okay, now this is what we're going to do. We're going to start firstly by removing the cost out of our books. Okay, that's what we're going to start. Where we're going to start this cost must start by affecting our vehicles account. So when we do that using the bargain, when we use the accounting equation, we were gonna say debit asset disposal and then credit vehicles. I'm gonna show you something. Okay, and then we use that code. What was the total? I think the total was 42,000. So we're starting with the first part. So it was gonna be 42,000. And then we have shown the effects of the first part. Now we need to take this information that we have written here and transfer it to the accounts that we're supposed to deal with. Okay, now let's go to this account. We know that this thing was costing us 42,000, and this this vehicle that we sold, it was sold on 31 December 2000. So what we can do is to draw a timeline here, okay, but we will come back to that when we have to do the depreciation for that. And then we're going to come here and check on our accounts. Remember, we said that vehicles account will be credited, so this means that on 31 December 2000, we will have asset disposal. This information is from the general journal, and then the cost price is 42,000. Okay, so we are done with the first part. We need to show effects also on the asset disposal account, because whatever that we're saying is going to be debited must be debited. Whatever we said that's going to be credited must also be credited. So we're going to go to the asset disposal account. Here we said that the asset disposal account will be debited. So it means that we're going to debit the asset disposal account by vehicles. Okay, so we're going to come here and say on the debit side, on 31 December 2000, and then we say vehicles, general journal, and then we have that 42,000 here. And then you are done with showing that part to show that this asset has gotten out of the business. But then remember, we have only dealt with the part of the cost price. So let's go to the transaction and understand what more should be done. And then now they're saying that this vehicle, which cost 42,000, it was sold for 18,000 cash. Okay, now we are seeing another account that was also affected. They're saying that it was sold for 18,000 cash. So it's fine, we deal with that part. We show also that in this case they will debit bank. The bank has to increase, so we're going to have DR bank, and then credit asset disposal. Okay, so this means that the bank account will increase because we are receiving 18,000, and which is what we say. So even when we go to the asset disposal account, what we're going to do, we're going to show on the credit side that bank will credit the asset disposal account. So what I'm going to do, this page will be for accumulated depreciation, so I'm just gonna write it maybe here. We'll have 31 December 2000, and then we'll have bank here. And then remember, this information about us receiving money is from the CRJ, and then we are receiving 18,000 cash. So we don't have the account for the bank account, so it will not be affected in this activity. We will not show the effects on the bank account. So we are done with the part, and then let's check if there's anything that we need to check. Okay, and then you also want to be able to determine whether this thing was sold for profit or not, but we'll go into that now. The second part says we are told that the depreciation is calculated according to the reducing balance method, meaning that it's calculated on carrying value. This means that each and every time when you want to calculate depreciation, you need to take your cost price and minus accumulated depreciation, and from what you've gotten, then that's when you will start to calculate the depreciation for the current year. We were told that this vehicle was sold on 31 December 2000. Okay, so we're going to do that timeline. Remember here, it's July, August, September, October, November, December, January, February. Okay, let me, maybe after December, let me use a different pen. Why is that eraser? Okay, let me use a different pen so that we can be able to see what's happening. So we know that from here, so we're going to try a different pen. Remember, it was sold here, right? So we're going to have remember, yes, December, and then it's January, February, March, April, May, June, and then this is June 2001, and then this here is 31 December 2000. So if you check from here to here, from July to December, it's 6 months, because it's 1, 2, 3, 4, 5, 6. It's 6 months. So this means that we've had that particular vehicle for 6 months. So what are we going to do? We're going to try and calculate the depreciation of the sold vehicle first. Okay, so we're going to check here and check what was the accumulated depreciation of that particular vehicle that was sold. We are told that accumulated depreciation on vehicles on vehicles, it was accumulated depreciation on vehicles was 14,000 at the beginning of the year. So we know already that the accumulated depreciation was 14,000, right? And then the cost price was 42,000. So we want to find the carrying value before we calculate the current depreciation. So what are we going to do? We're going to say 42,000 minus 14,000. I'm gonna come here and say 42,000 minus 14,000, and then it will give us our carrying value for this. It will give us our carrying value for this vehicle. So 42,000 minus 14,000 of the accumulated depreciation is equals to 28,000. So we know that the answer that has been given to us is 28,000. So this is our carrying value now before we calculate depreciation for the current year, and this is the cost price, this is the accumulated depreciation. So we know that carrying value is equals to accumulated depreciation minus, cost price minus accumulated depreciation. Now we need to think about the rate of depreciation. We were told that the rate of depreciation is 20% per annum on using diminishing balance method. So that's 20%. So we know that the rate is 20%. So we have the carrying value. It means that the current depreciation of the sold vehicle will have to be calculated on this. Okay, so it's going to be 28,000 multiplied by 6 over 12 multiplied by 20 over 100, and then we'll be given our current depreciation for the sold vehicle. So we're getting, the answer that I'm getting is 2,800. So remember, this is for the sold vehicle. Okay, so this is the depreciation for the sold vehicle. So now for us to get the total accumulated depreciation, this means that the total accumulated depreciation of that particular asset total accumulated depreciation will be equals to 14,000 plus 2,800. We know that 14,000 plus 2.8 is equals to 16,800. So this is the accumulated depreciation that we must take out of the books of the business. Okay, so we're getting 16,800 on the accumulated depreciation. Okay, so we already got the total accumulated depreciation. So remember, when we show this, we say, because we are selling, we're saying that we debit accumulated depreciation, and then we credit asset disposal by 16,800, and then also 16,800 this side. So we've already shown the effect on both the accounts here. So we need to go there and check what we say. So remember, we said 42,000 minus 14,000 gave us it gave us, I think, 28,000, something like that. It gave us 28,000, and then 28,000, if you calculate from July, August, September, October, November, December, July, August, September, October, November, December. So you can see it's 6 months, and then you multiply by 6 over 12, you multiply by 20%, you still get that depreciation, current depreciation of the sold item of 2.8, and you take that 14,000, you add plus 2.8, you will have the accumulated depreciation for that sold vehicle of 16,800. You take this information, you go to the two accounts that are affected. I want to deal with the one that was sold and finish with it. So you must know how to work these things out. And then once we're done with this, we're not gonna struggle. We just need to calculate depreciation for the current vehicles that are remaining after the one that was sold, and then also the depreciation for the new one, and then from there we close off those accounts, will be done. So it's not that bad. So we know that we said on our calculations that we're going to debit accumulated depreciation. Okay, now check, accumulated depreciation is being debited. The account that's supposed to debit it, it's the one that is being credited, which is the asset disposal. Okay, now we're going to go to the accumulated depreciation account. Remember, because we are disposing, the accumulated depreciation account should be reduced. And then when was this vehicle sold? On 31 December. So here we're going to, on 31 December 2000, sorry, we're going to have asset disposal. This information is from the general journal, and then the amount is 16,800. Then you go to that asset disposal account. You see, accumulated depreciation account has been debited, so it means asset disposal account must be credited. So we're going to come here and say 31 December 2000, and then we say accumulated depreciation. But then remember, this is on vehicles. You must show that it's accumulated depreciation on vehicles by 16,800. Okay, so even here, maybe let's go and correct that part where I was showing you how to deal with the accumulated depreciation. Even here, you can remember the accumulated depreciation is on vehicles. It's very important that you show which accumulated depreciation are you referring to. You don't just say accumulated depreciation. So the accumulated depreciation on vehicles will reduce by 800. So the first part of that we are done. Now we want to be able to determine whether this was sold on cash or on credit, on profit or on a loss. So what we're going to do is we're going to compare the carrying value and the selling price. So now we know that cost price is equals to 42,000. Accumulated depreciation, we know it's supposed to be at 16,800. So whatever that we're gonna get here, it will be our carrying value. So 42,000 minus 16,800 is 25,200. So this is how much we were supposed to sell our vehicle. Now we want to check how much did we sell it. We sold it for 18,000 cash. Okay, now we know our carrying value, which is which is 25,000. Let me just erase so that we can have clean work. When you do this, you must show your workings. It's very important. So we know already that our carrying value is supposed to be 25,200, which comes from 42,000 minus 16,800, and then our selling price was, we sold this for 18,000. Our selling price was 18,000. So this means our profit, we're not gonna have any profit, because already you can see, we were supposed to sell this for 25,200, but we sold it for 18,000. So we sold it below the carrying value, therefore we'll have loss on sale of assets. So 25,200 minus 18,000, we have a loss of 7,200. Okay, now in order for you to be able to see if you had a loss, your credit side should be short. Your credit side of the asset disposal will be short. It won't be equal to the credit side, to the debit side. So we're gonna go and confirm that. Now on the account, you can already see that there is something that is missing here. So whatever that's missing, that's our balancing figure, and then this account doesn't have a balance brought down. So once you close it, we close it. So the total here, from, if you check 16,800 plus 18,000, it's below 42,000. So it means that the total here will have to be 42,000. Okay, this account, this one is only, I think it's 7 marks or something like that. It's 42,000. Now you can see that the credit side is short. So because the credit side is short, we're going to have on 31 December 2000, we're going to have loss on sale of asset. Okay, and then the loss on sale of asset will be the difference between this one and this one. So 42,000 minus 18,000 minus 16,800 gives us 7.2, which is the loss that we got from the other side. So it means this thing is correct. The way we've done it, that's correct. The information is corresponding, and you can see here the loss at 7,200. So the asset disposal account has been properly closed. You get your free 5 marks. Okay, that is how you're supposed to do the asset disposal account. Now we're now going to focus on important things now. So what we're going to do, we're going to look at the vehicles that are remaining and the new one, and check the depreciation. So we already know, my teacher used to do it like this, that like on depreciation, remember the side we're supposed to have depreciation, and then this is shown in the general journal. Okay, so already so far we know that our depreciation for the sold one was 2,800. Then we're going to add plus. Now we want to check the vehicles that were remaining now at the beginning of the year. Now remember this, because this was sold on 31 December, this means there's 14,000 is still part of this accumulated depreciation. So to get the depreciation of the old vehicles, we need to take out accumulated depreciation of 14,000 from these. Okay, so we need to take out that there's 14,000 from 56,000. So we're gonna come here and say depreciation. Let's use a different pen. We're going to come here and say depreciation, but then this is on old vehicles. Okay, and then we know that the opening balance was 56,000. The one that was sold at the beginning of the year, had a accumulated depreciation balance of 14,000, and then the balance, the accumulated depreciation for the 6 months of the current, the depreciation of the current financial year was not added to this, because this balance, 56,000 balance, was on July the 1st, 2000. So it doesn't include that 2.8, it only includes 14,000. So we subtract that 14,000. 56,000 minus 14,000, we get 42,000. Remember, this is your carrying value, this is your accumulated depreciation, and then this is also your accumulated depreciation, but then this is for the sold on, it's for the sold one. Okay, and then this is on 1 July 2000. So meaning that this is the balance at the beginning of the year. So hence we are subtracting it so that we can be left with the accumulated depreciation of only the vehicles that are remaining in the current financial year. So we're getting the carrying value of 42,000. So we're going to have 42,000 here. Remember, these ones, they were with us for the entire year, so it's going to be 12 over 12 and then times 20 over 100, and then we get our answer. So 42,000 times 20% gives us 8.4. So this is the depreciation for the vehicles that we've had at the, oh sorry, please let me correct this. We're not supposed to calculate on this. I forgot that this is not the cost. Okay, it's a good thing that we remember. So remember, this is not the carrying value. This is not actually the carrying value. This is This is the depreciation of old cars now. So it's going to be this 42,000. It will be depreciation for old vehicles. The cost price CP we know is equals to 168,000 at the beginning. The cost price was 168,000. So you see, you need to pay attention to such things. It's easy to make mistakes in this question. Remember, the cost price of vehicles at the beginning was 168,000, right? So we, from this accumulated depreciation, we subtracted the opening balance of the one that was sold. So even here, we must subtract the cost first before we calculate the accumulated that particular depreciation. So from 168,000, I forgot where I wrote it down. From that 168,000, remember, this is the CP, the cost price, which also include the one that was sold, and then this is 42,000. We must subtract 42,000, and then this is the depreciation for the the cost price of sold vehicle. Remember, we want to be left with the ones that are remaining now. So if you take 168,000, you minus 42,000, you get 126,000. So now this 126,000 minus that accumulated depreciation, which is this one, 56,000 minus, remember, this is ARC debt, it's the remaining accumulated depreciation, this one. Okay, so it's the remaining accumulated depreciation. So 126,000 here now represent our cost price of remaining vehicles before we consider the one that was bought. So when 126,000 minus the accumulated depreciation of, let's see, 56,000 minus I think it's 14,000. 56,000 minus that 14,000. Unfortunately, I can't take out that part where I made an error, but I think you should be able to see that I corrected that. So, but let's continue. So we know it's gonna be 56,000 minus that 14,000 of the one that was sold. Okay, now we minus that 14,000 so that we can get the accumulated depreciation of the vehicles that were remaining, which is 42,000. So it's 42,000. Then we're gonna get our carrying value here. Remember, this is at debt, and then as for the ones that are remaining, it's very important that you always remember this. And then we said 168,000 minus 42,000 of the sold vehicle, it gives us 126,000. And then we said 56,000 minus 14,000, we get 42. So okay, so 126,000 minus 42,000, we're getting 84,000. So the carrying value of the old vehicles, it's 84,000. And then we're going to take that 84,000 multiplied by 12 over 12, and then multiplied by 20 over 20 over 100. I think this is a new page. Yeah, I think it should be a new page. So 20 over 100. Okay, so we will get our answer. 84,000 multiplied by 0.20 gives us 16,800. So this is the depreciation for remaining ones. for remaining vehicles. This is, the tricky part about this accumulated depreciation is when you're supposed to subtract the cost of the one that was sold from the opening balance, and as well subtracting the accumulated depreciation from the opening balance of this. So subtracting the sold the accumulated depreciation of the sold vehicle on the accumulated depreciation of all the vehicles at the beginning of the year. So that's where the tricky part is. I think you need to be patient and not rush when you reach that part. So we got our thing as 16,800. So now already here on the T account, we're going to add here plus 16,800, and then we need to add now the depreciation of the new one that was recently bought. Okay, we are almost done. I think we've sold the asset disposal part. We need to show how the balance of the one that was bought too. We need to include it in our workings. So to confirm our information, we need to go back there and check. Okay, accumulated cost price of the vehicles that we had at the beginning of the year, 168,000 minus the one that was sold, which costs 42,000. We're remaining with 126. So far we know our cost price for the old vehicles is correct. Now accumulated depreciation 56,000 minus the accumulated depreciation of the remaining of the sold vehicle, it's 14,000. So we left with 42,000. So 126,000 minus answer is equals to 84,000 minus by multiplied by 20% gives us 16,800. So which means that our depreciation for the old vehicles is correct. Okay, so now we now have to check the depreciation of the new one. Now they're saying that we purchased a new vehicle on 28 February 2001 for 54,000 on credit from Must Have Motors. It's okay. So what are we going to do now? We are almost done with this question. So what we're going to do is to now draw the timeline again. Remember, it's July, August, September, October, November, December, January. Okay, now we need to be smart and change the pair, because why? We're now going to start on calculating the depreciation for that one. Remember, it was bought on 28 February 2001. So already it was bought at the end of the month. So because it was bought at the end of the month of February will not count. We'll start calculating as depreciation on the next month. So it means February will fall here. We'll start calculating from here and going forward, from the next month going forward. So we're gonna change our pen again and maybe use red now. So we know that since it's February, it's at the end, so it's going to be March, April, May, June, and this is where our year ends, 30 June 2001. And now if you count, if I bought something at the end of February, I will not calculate February as the month where I start to depreciate, because that vehicle was not with me for the entire month. It was only there with me for 1 day at the end of the month, which we cannot count. Okay, so it means you're gonna start calculating depreciation. I don't know if I forgot to say for what. Okay, let me just, so it means you're going to start calculating depreciation from March, April, May, and June. Okay, so you can see March. Remember here the date. The date is saying 28 February, which means you don't count February. If it was 1 February, we were gonna count it. But then because it's 28 February, we don't count it. So it's going to be March, April, May, June. So it's 4 months too. But in this case, because we don't have accumulated depreciation for this particular vehicle that we have bought, we're going to calculate that depreciation on cost for the first year, because we don't have accumulated depreciation of that vehicle, okay, that we have recently bought. It has not yet depreciated. So we just calculate the accumulated, the depreciation for the current 4 months on the cost price. So we can do that here for this one. So we're going to say 54,000 multiply by 4 over 12, and then multiply by 20 over 100, and then we get our depreciation. So it's 54,000 multiplied by 4 over 12 multiplied by 20 over 100, which gives us 3,600. So this 3,600 will increase our accumulated depreciation. So remember, February you don't count. Maybe we can count for us to be able to see if we are correct, for us to be able to calculate the months that this thing was not with us. We can start from 1 July and end on 28 February. You'll realize that it will be 8 months if we are correct. And from July, August, September, October, November, December, January, February, it's 8 months. If you take the 8 months plus that 4 months, is equals to 12 months. So in this case, 8 months, we did not have this new vehicle for 8 months. So this means that we only had it for 4 months, because our financial period is out of 12 months. Okay, so the answer that we get here is 3.6. This 3.6, we'll put it here on the T account as the new depreciation, and then it will be plus 3,600, and then you add. So now we're going to try and balance the sides, okay, so that we can have the new balance. But then before we do that, we need to come here and record first. So on 28 February 2001, and then creditors control. Or what you can do, you can write the name, creditors control will be fine, and then here you write CJ, and then we bought that new vehicle for 54,000, and then from there we try and balance the sides. The most calculations were on this part, like you being able to calculate the accumulated depreciations, and then remembering that this one and this one should be the same. So what we can do now is to try and close off this vehicles account, because we only sold and bought a new one, and the new one that was bought, it was bought on credit according to here. So every time you see credit, think of creditors control. There's no money outflow in the business. Okay, so let's try to close off that account. Already I can see that this side is big. 168,000 plus 54,000, that's 222,000. So I'm just gonna close them. So it's 222,000. And then you can already see that on 30 June, (2001) balance carried down. This means this is the closing balance. The dates are very important. So balance carried down as the difference, and then your balance on 30 June here will become your opening balance here on 1 July 2001, and then balance brought down. That's all they want you to do. So now we're going to say 222,000 minus 42,000, and then we get 108. So this means that the new balance was 180,000, and here 180,000. You have done this account, you have already closed it off. Remember, on the information they said you should close it off, and remember, for me it might take me more time because I'm explaining to you, so don't be surprised when I take more than the required time. So we're done with this account. It's sorted, it's closed, you get your free marks. And I will advise you to always verify your calculations. 168,000 plus 54,000. Okay, so it's fine. So now we need to close off the accumulated depreciation account. So 2.8 plus 16,800 . Okay, let me try and remember where we got the 16,800, because so I forgot how I got that one. Okay, so 84,000 multiplied by 0.20. Okay, now I remember where we got it. So now what are we going to do? We try and totalize this, and we put the total here. So 2.8 plus 16,800 plus 3.6 is our depreciation for the year, which is 23,200. 23,200. Okay, so we're done with depreciation for the year. You just add them. 2.8 plus 16,800 plus 3.6, you get your total, which is 23,200. So we are done with that part. It has been sorted out. So now we're going to add this part to show you that the balance will be on the credit side. This side you can see that already it's more, so this means the shortage will be here. So on 30 June 2001, balance carried down and then the totals here. And then we can have here something like on 1 July 2001, balance brought down, which will be the shortage. So 56,000 plus 23,200 will give us the total then of the bigger side. 56,000 plus 23,200 is equals to 79,200. So that means we'll have 79,200 as our total here. 79,200, and then even here 79,200, and then let's confirm if it's correct. 56,000 plus 23,200, 79,200. Okay, let's confirm. 2.8 plus 16,800 plus 3.6 is 23,200. So we done. The bigger side is correct. Let's check the difference. How much? What is the shortage on the debit side? We can only find out by saying 79,200 minus 16,800 of the asset, then the accumulated depreciation of the sold vehicle. It's giving us 62,400. So this means this is our closing balance, 62,400, 62,400, and then voila, we done. Your 35 or 34 marks. That's how you're supposed to get it. So guys, it's very important that you practice. Get as many examples as you can. There are many examples on the internet that can help you to have a better understanding of asset disposal, your income statement, and everything. They show you most of the things that are tested in exam. When I was doing my high school, we had such transactions, which is why it makes it easy for me to recall these things. So practicing will really help you a lot. Okay, if there's any mistake that I've made on this activity and you have watched it and attempted to do this, or maybe if you want me to send you the question of this exercise, you can email me on the details that will appear at the end of this video. In the meantime, please make sure that you leave your comments on the comment section. Make any suggestion that you want to make, but then please remember to stick to our community guidelines. Okay, keep your comments as respectful as much as possible. Try to respect everyone. Okay, I want to confirm something, because hey, wrong answers, we don't forget that. Okay, so guys, I've done everything. I've done the best that I could. Please, when you watch this, make sure that you go through every transaction step by step. Make sure that you read the full question. One of my favorite accounting examiners likes to say that read the full question. Make sure that you read the full question. Try to write down information as much as possible so that you don't forget. If you have really enjoyed this session, please like this video and leave your comments on the comments section. Please, if you have a sibling who's doing accounting or is having challenges with accounting, please let them know that we are willing to help as Chauke tutorials. It doesn't matter where you are, as long as you're in South Africa, I can reach you. Online is paid. So please, if you have any problems with accounting, get in touch with us by using the details that will appear at the end of this video. With that being said, thank you so much for watching, and then may the good God, the God of hope, the God of peace, the God of all love protect you and keep you safe. But to please stay safe. And those who are writing examinations, I just want to wish you guys nothing but success, and I believe in your abilities. I believe that you guys can do it. And if you want me to also help you to do the property plant and equipment notary using this information, please get in touch with us. But you must remember that that one will be a paid lesson for only 70 rand. If we are doing a pre-recorded lesson like this one that you'll be watching, 70 rand is all that we ask from you. And then if you want a lesson on Skype, Microsoft Teams, or even Zoom, we will be willing to assist you with that. Our live sessions only cost 100 rand per hour with a bonus of 30 minutes. So keep that in mind. If you need anything, stay in touch by using the details that will appear at the end of this lesson. With that being said, thank you so much for watching our online lessons with Aubrey Chauke. I hope that you have really learned in this lesson and that your understanding of asset disposal has increased. Stay blessed.